Have you ever wondered why we don't use gold to buy things anymore? Why is our money just ... paper? For a long time, money wasn't just paper. It was a promise. A promise that you could walk into any bank and exchange your banknotes for a fixed amount of real, solid gold. This was the era of the gold standard. Let's dive into the fascinating story of its rise, its golden age, and why it ultimately disappeared. Our story begins in the late 19th century. Imagine the world as a bustling marketplace, with countries trading goods and services across borders. But there's a problem. Every country has its own currency. How do you figure out a fair exchange rate between the British pound, the French franc, and the US dollar? The solution was simple and elegant. Link them all to something universally valuable. And what's more universally valuable than gold? Great Britain was the first major player to formally adopt the gold standard in the early 1800s. By the 1870s, many of the world's major economies, including Germany, France, and the United States, had followed suit. This period, from about 1872, the start of World War I, in 1914, is often called the classical gold standard era. So, how did it work? It was straightforward. Its government guaranteed that it would convert its currency into a specific amount of gold on demand. For example, the US dollar was defined as being worth about 1/20th of an ounce of gold. This created stable exchange rates. If you knew how much gold a dollar was worth and how much gold a pound was worth, you could easily calculate the dollar-to-pound exchange rate. This stability was fantastic for international trade and investment. Businesses could plan for the future without worrying that currency values would suddenly swing wildly. It created a sense of global economic predictability that had never existed before. The system also had a clever, self-correcting mechanism. Let's say Britain started importing more than it was exporting. This meant more British pounds were flowing out of the country to pay for foreign goods. Foreigners would then exchange these pounds for gold from the Bank of England. As Britain's gold reserves dwindled, its money supply would shrink. A smaller money supply meant prices would fall, a process called deflation. Cheaper British goods would then become more attractive to other countries, boosting exports. At the same time, imports would become more expensive for Brits, so they'd buy less. Eventually, the trade balance would correct itself, and gold would flow back into the country. It was like an automatic economic thermostat, keeping everything in balance. For a few decades, this system worked beautifully. It was an age of unprecedented global trade, capital flow, and relative economic stability. It felt like the world had finally cracked the code to a perfect monetary system. But this golden age had a fatal flaw, one that would be brutally exposed by the chaos of the 20th century. The system's greatest strength, its rigidity, would also become its greatest weakness. Then, in 1914, the world plunged into World War I. The automatic thermostat of the gold standard was switched off. To fund the immense cost of the war, countries needed to print massive amounts of money, far more than their gold reserves could back. They suspended the promise to convert currency to gold. The cooperative spirit that underpinned the gold standard was shattered by conflict. After the war, there was a desperate attempt to put the pieces back together. Countries tried to return to the gold standard in the 1920s, hoping to recapture the stability of the pre-war era. Britain, for instance, went back on the gold standard in 1925 at the pre-war exchange rate, but the world had changed. The US had emerged as the dominant economic power, holding a huge portion of the world's gold. War debts had scrambled the old economic relationships. Turning to the old system was like trying to fit a square peg into a round hole. For Britain, this decision proved disastrous. The pound was now overvalued, making British exports expensive and uncompetitive. This led to high unemployment and economic stagnation. The automatic balancing act of the gold standard wasn't working anymore. Instead of gently guiding economies, its rigidity was now strangling them. The final blow came with the Great Depression, which began in 1929. As economies crumbled and banks failed, people panicked. They rushed to convert their paper money into gold, fearing the paper would soon be worthless. This run on gold drained government reserves at an alarming rate. Governments faced a terrible choice. They could stick to the gold standard, which required them to raise interest rates to attract gold and keep their money supply tight. But in the middle of a massive depression, this would only make things worse, deepening the recession and increasing unemployment. The alternative was to abandon gold. This would allow them to lower interest rates and increase the money supply to stimulate the economy, even if it meant their currency would lose value internationally. One by one, countries chose survival. In 1931, facing a massive drain of its gold reserves, Great Britain officially abandoned the gold standard for good. The United States followed in 1933, with President Franklin D. Roosevelt famously making it illegal for private citizens to hoard gold. The classical gold standard was dead. By leaving it, countries regained control over their monetary policy. They could now use tools like interest rates and money printing to fight unemployment and manage their economies, a practice that forms the basis of modern central banking. But the story of gold wasn't quite over. At the Bretton Woods Conference in 1944, world leaders designed a new system. It was a sort of gold light. Other currencies were pegged to the US dollar, and the US dollar itself was pegged to gold at $35 an ounce. For a while, this brought back a degree of stability, but the same old pressures returned. The US was spending heavily, especially on the Vietnam War and social programs, and was printing more dollars than it had gold to back. Other countries, particularly France, grew nervous and began demanding gold for their dollars. The breaking point came in 1971. President Richard Nixon, facing dwindling gold reserves and a potential crisis, made a stunning announcement. He unilaterally closed the gold window, ending the conversion of US dollars to gold. This act officially severed the last link between the world's major currencies and gold. Since then, we've lived in an era of fiat money, money that has value simply because the government declares it does, not because it's backed by a physical commodity. So why did we leave gold? Ultimately, the gold standard was too rigid for the modern world. It tied governments' hands, preventing them from responding effectively to economic crises like the Great Depression. While it provided stability in calm times, it became a golden straitjacket during storms. Today's system of flexible exchange rates and independent central banks gives governments the tools they need to navigate the complexities of a globalized economy. The era of gold-backed money is a fascinating chapter in our history, but it's one we've firmly closed. Thanks for watching. It's a complex topic, but I hope this helps you understand the journey of our money. If you found this interesting, don't forget to hit that like button, subscribe for more content, and let me know your thoughts in the comments below. See you next time.